You're listening to Compound Insights, a podcast by CFA Society New York. Today on the podcast, we're going to try to answer one question. Is ESG becoming SRI? And we're doing that today with Henry Schilling. I'm Rob Rowan. Henry recently launched a website, sustainableinvest.com, and it's devoted to independent sustainable research and analysis. He's been working in the investment management industry or focused on the investment sector for approximately 45 years. He was recently with Moody's Investor Service until June 30th of last year, and while at Moody's, he initiated and coordinated Moody's global efforts to disclose and add transparency to the reflection of environmental, social, and governance risks in credit analysis, research, and ratings. Henry is the author of the International Guide to Securities Market Indices, which was published in 1996 by International Publishing Company, and he is a contributor to money market funds in the EU and US, published by Oxford University Press. He has a BA in economics from Lehman College at the City of New York. All right, so today we're talking about and asking a question, is ESG becoming SRI? Before we get into this, Henry, I wonder if we could start with how you define ESG and SRI for our listeners, because so many people talk about it in different ways.
Right. And certainly I think, Rob, that it's important to define those terms because people have different views about what they mean, and what they mean will have an influence on the way in which asset owners think about the implementation of due diligence approach that they might take relative to external managers. So I think it's a good point to start. And what I would say, and at least in terms of my work, I think about an umbrella term of sustainable investing. And sustainable investing, in my view, encapsulates at least 5 broad sustainable investing strategies. And most practitioners, I think, agree that these encompass the following. So first is values-based investing, investing that take into consideration maybe ethical, social, and religious factors. Typically, these are implemented through exclusionary or negative screening practices, which in their own right represent yet another category of sustainable investing.
Right, so what types of things do you think are most commonly screened out by asset owners with ethical goals? And maybe some of the church ones are good examples.
By far the largest, and when I talk about the largest, I'm using assets under management viewed through the prism of U.S. mutual funds and exchange-traded funds,
Okay.
of which there are about, as of the end of July, $781 billion in assets, so it's almost three-quarters of a trillion.
Right.
By far the largest would be focused on excluding or screening out companies that are involved in the manufacturing of weapons and or tobacco.
Okay, great. So that's values. And 2?
Actually, the third, because exclusions may be employed
Okay.
by sustainable investing, by firms that engage in sustainable investing strategies, but that are not ethically based. So the third would be impact investing and thematic investing. And the fourth, and probably the fastest growing, and by some account probably using the measures that I just mentioned, represents the dominant approach, is ESG integration.
Right.
And I think it would be useful to define ESG integration. I actually think about it in the way that the CFA Institute has defined ESG integration, which is the consistent and systematic accounting of environmental, social, and governance risks and opportunities where these are both relevant and material to investment decision making, whether it be in the equity side or fixed income side or some other asset class. that's really an anchor for thinking about ESG integration.
I love the relevant and important in all these integration things. You think about that in sort of compliance and the need to know things that many of our listeners will be familiar with because every year they have to do their compliance videos. But one of the other things that takes a long time is this integration process. And I've talked with some asset owners who are in year 2 of the integration process. Is that consistent with your experience in the asset owners you've been speaking with?
ESG integration is a relatively new approach that has been adopted by both traditional, in some respects, and traditional asset management firms, as well as those legacy firms that have been practicing responsible investing for a long time. And responsible investing is just another subset of sustainable investing, and it's still an evolving sphere. I don't think anyone really has a comprehensive view about how this should be reflected in their investment strategies, and it's likely to change over time.
Right. Yeah. I know that some asset owners began the process and are now rethinking it. In preparation for one of our upcoming conferences, I was working with one who's about a year into it, and she actually said, "We're trying to figure out what ESG is." And I thought that was a sign that maybe the cart has gotten ahead of the horse in the process for some.
Yes, and I think it's also fair to point out that while sustainable investing has been reflected in equity-oriented strategies for some years now, the shift or the pivot, if you will, to fixed income investing and other asset classes is a more recent phenomenon or a more recent development. And the fixed income space is very complicated, much more complicated in my view than equities, for at least 2 reasons and perhaps even more. First is the fact that you've got a maturity consideration to reflect in your thinking about how to apply ESG. And secondarily, you've got a variety of different security types,
right,
that potentially have different outcomes if you're thinking about applying a opportunity lens or a risk lens.
Right. I didn't really think about that. If you think about it, sort of one end of the spectrum is geo debt that everyone had in their portfolio until the stock market took off back in the 90s, and interest rates dropped. And then sort of at the other end of the spectrum, you have all these strange outgrowths of the structured market as well as the infrastructure market that go through a wide variety of permutations, except that they all basically pay a coupon on some level. So
that's right.
Yeah, that is fascinating. I really
Yes,
think about
and
that.
if you have the securitization market is, as you suggest, a very good example. If you've got an automobile securitization transaction or a mortgage-backed securitization or airplane leasing deal, the way in which ESG might play out is going to be very different and might require a different set of skills relative to an senior unsecured obligation of a corporation.
Right. Interesting.
There is yet the 5th strategy, which is shareholder, bondholder engagement, as well as proxy voting.
Right.
And so I think that would be the 5th strategy that is encapsulated under this broad umbrella of sustainable investing.
Now, that one is the provenance of the very large asset owners, right? Are there ways for mid-sized asset owners or relatively small organizations to engage in that proxy voting in a way that has an impact?
Small versus large, I don't think is as material to the engagement process on the equity side as might be the case with fixed income investing, where large investors, like a BlackRock, for example, or Fidelity, might have more clout with the issuers at the time that these fixed income instruments or bonds come to market.
Right, at the most critical time, yeah, for sure. All right, so let's circle back to the question, is ESG becoming SRI? So what do you say?
I'm not convinced that it is becoming SRI, and I'll tell you why. I'll tell you why. If you reflect back on my definition of ESG investing, a positive societal outcome, which is implied by the terms socially responsible investing, is not necessarily an outcome that is explicit in the process of applying the strategy. And by that I mean taking into account ESG risks and opportunities will influence the way a company might think about how a security is priced at any given point in time relative to where they see the valuation likely to fall out over time. But it may not be correlated directly to a positive societal outcome, which I think is implied by the sustainable or responsible investing approach.
Okay, could you give us a sort of where the rubber meets the road example of how that might work? Take a large mutual fund or a large passive manager, anything like that.
I would perhaps much rather focus on a particular security.
Okay.
So let's take recent examples. In the case of Wells Fargo, for example, or in the case of even Facebook, or more recently Boeing.
Yes. Yeah.
A strictly ESG approach using the CFA Institute definition might play out something like this. We recognize that in the case of Boeing, for example, there may have been some governance issues that perhaps from a strictly SRI point of view might lead a manager to reduce exposure to that company or even eliminate exposure to the company altogether. But someone who is strictly focusing on ESG risks and opportunities might come to the conclusion that perhaps some of the risks may have been overplayed given the share price at this point in time. And that manager may believe that those risks have been fully priced in, so it may still be an opportunity to buy.
Okay.
And it may be held in the portfolio as a consequence of that.
Okay. That's a good example. Do you want to talk about Wells Fargo?
Well, Wells Fargo, very similarly, you had some years of significant, in some cases, fraudulent practices being employed by employees of the company. There have been governance issues associated with the way Wells Fargo conducted its business. And you can make the argument that ESG scores, if you were to think about Wells Fargo from the point of view of how you would evaluate it based on its ESG practices, probably has a fairly low score relative to others in the sector. And that, on one level, could lead to the reduction in exposure to Wells Fargo and maybe the elimination of Wells Fargo stock altogether. But if those risks have been fully priced into the share price and one thinks that there may be an upside opportunity, I could see a manager holding the security, at the same time explaining to investors why it has made a decision to hold the stock. Furthermore, there may be an opportunity to use the holding of Wells Fargo stock as an opportunity to work with the company to improve some of its practices through this engagement process. And that might be another reason to hold the stock. So that's the way it might play out.
So this current trend, if I understand this correctly, this current trend isn't precisely a higher or lower risk for these types of strategies. It boils down to all the traditional things that we've ever done in security analysis. It's another layer on securities analysis. Is that what you're saying?
With regard to ESG integration, as it's been defined by me and as adopted from the CFA Institute methodology, just to digress just a minute, or it's actually a segue, but I spent 25 years at the credit rating agency. And the role of the credit rating agency with respect to credit ratings is to evaluate debt and provide an opinion around whether the issuer is going to repay the obligation in full and on time. And the rating agency, appropriately so, posited that all relevant and material risks could have influenced their assessment of creditworthiness were taken into consideration. And that included, quite frankly, ES and G.
Right.
So That's something that's been done all along, whether it's in public finance, whether it's in corporate finance and other areas. But what was not abundantly clear is with respect to these particular considerations, ES and G, it wasn't entirely transparent how the rating agencies were going about reflecting those in their overall assessment. And so what had changed at the rating agency is not so much the methodologies, but their stepped up efforts to improve transparency and provide more research around how that was taken into consideration.
Sorry, the difficulty of this for the rating agencies, of course, is they don't want to make their process too transparent to allow issuers to front run the ratings process, right? So this is a difficult thing, but I think it is interesting that they really didn't change their analysis. They just lifted the veil on it a little bit. I wonder if you have a view on how that has changed in the equities world. Do you believe that there is a difference in the disclosure around due diligence processes at equities managers firms?
With regard to equities, the emphasis has been on gathering data and information that would allow investment managers to more effectively reflect those risks and opportunities in their process and valuation modeling. And as in more recent years, as environmental risks has become more pronounced, there's been a greater emphasis on securing from various companies and other entities as much data that could be evaluated in a consistent manner as possible in order to more effectively conduct fundamental analysis. So I don't know that there's been necessarily a change in approach and methodology as much as emphasizing data and the quality of the data in order to make better investment decisions.
Right. So that is, and this is, I guess, an interesting place to pivot to the future in one respect, because we've got a lot of assets. We've got clarity from the rating agencies on the fixed income portion of it. We've got increasingly better data on ESG for equities managers, and obviously a lot of interest. So where do you think this goes next? It's formal, it's here. There's probably a risk out there. What do you think it is? Or what do you think they are, I should say?
From the point of view of asset owners and their expectations, let's say, from the investment management community that has been referenced, has been responding, I think, to the needs, requests, and evolving objectives of the asset owner community, whether that be public pension funds, endowments, foundations, insurance companies, banks, whatever have you. I think asset management companies, at the very least going forward, will have to step up their disclosures around, first, the type of frameworks that they've adopted for the purpose of meeting the needs of the asset owners. I think that there is likely to be greater disclosure that focuses on how buy, hold, and sell decisions are made relative to ESG considerations, if we're referring to an ESG strategy that is being employed by the asset management companies. That's not currently being offered by the investment management firms. I think there's going to have to be greater emphasis on disclosure around performance analysis and performance attribution. What impact is this strategy having on the final results? Because in the end, asset owners, I think, attempting to achieve a dual objective, which is market-based financial returns and at the same time achieving a positive societal outcome.
Yeah, the thing that's interesting about that is I see some of those forecasts are actually higher than market-based returns. And that makes me a little bit nervous because forecasts aren't bankable. You can't eat forecasts. And so I'm a little concerned about what happens to the sector if it comes in below that.
There is a danger, there is a risk in that the notion of sustainable investing as a vehicle, if you will, by which you can achieve excess risk-adjusted rates of return may be oversold. While it's possible to, and we've seen significant evidence to validate the fact that companies that have taken on board, in addition to meeting the needs of shareholders, taking into account other stakeholder objectives, including, for example, employees, including the community, including suppliers, tend to experience accounting results that are superior to those companies that do not.
Right, right.
But whether that can translate into better portfolio performance is still too early to validate. First of all, because most of the, if we're focusing on ESG integration strategies in particular, those have been relatively short-lived, and they've only recently been introduced in portfolios.
Mm-hmm.
And to evaluate what impact these are having on portfolios going forward may be premature.
Right.
So that's number one. Number two, I don't see any, if we revert back to the view that this is part of fundamental analysis, there's no reason to believe that these portfolios should be performing any worse than any others over time.
Right.
So I would expect, at the very least, that these should be able to produce market-based returns.
Right. At market-based risk, more or less.
Exactly.
Right. Yep. Makes sense to me.
And the last thing I would say is that going forward, so far, employing these strategies has not been translated into transparency around what impact, to the extent that societal impact is a objective. It's not abundantly clear what impact these strategies are actually having or will have. And in time, I think asset managers will be called upon to provide more transparency around the impact of these strategies.
Yeah, that's interesting. And that is a matter of politics and societal values, which I think sometimes can change more quickly than Wall Street can, and sometimes can run 180s very quickly, much faster than Wall Street can. So I am a little concerned about what happens when the backdating process and the judgment with the rearview mirror begins also, and it probably will. So, well, that's interesting. So you have an event coming up that members who are listening might be able to attend. Could you tell us about that?
So I'm the co-chair of the Sustainable Investing Thought Leadership Group at the CFA Society, and every year we sponsor an annual event. The theme for this year's event is materiality. The event is scheduled to take place on or about November 15th. We've got we actually decided to add a new element to this year's event by preceding the formal one-day event with a primer on sustainable investing. So the day before the event, we'll have a 3-hour session, during which time we'll focus on what does sustainable investing actually mean, what are some of the opportunities and challenges, and give practitioners an opportunity to interact with members of the investment management community who have already been implementing these strategies. So a primer on sustainable investing, followed by a full day of presentations and panel discussions focusing on the whole subject of materiality and how that can be considered within the context of different asset classes.
Yeah, so members should also know that if November 15th does not work for you, you will be able to listen in to this on the web. So members don't necessarily need to be here, although being here is sometimes better. I would also add that the second annual ESG Summit is coming up on September 23rd and 24th. We do have a really interesting setup of panels there, but that one is Chatham House rules, so you will not be able to listen to that one online. So thank you, Henry, for your time here, and we'll look forward to your event.
It's my pleasure, Rob.
I hope you enjoyed our podcast. If you have not yet, please subscribe at the podcast app of your choice. Also, please visit us on the web at cfany.org.